All right. Welcome, everyone, to another episode of the Info Diet Podcast. My name is Michael Kimelman. Today, I'm joined by an author, an investor, uh, a former guest of the U.S. federal government, Mike Kimelman. He actually, his original book was Confessions of a Wall Street Insider, and he's coming out with a new book in the fall, Mastering the Basics of Cryptocurrency. Mike's going to talk to us today about his experience in the financial information world and how that can be generally applicable for him and us in general information. Mike, did I do a pretty good job with your intro, or is there anything more you wanted to say?
No, I think that was good. Like you said, I've written a book, got another book coming out in the crypto sector, Mastering the Basics of Bitcoin. Spent quite a bit of time on Wall Street and quite a bit of time off Wall Street in the blockchain field and as a consultant and advisor. So let's rock and roll.
Awesome. So the thing that most interests me initially about you when I came across you was that, you were one of the only people to go to jail in the 2008 financial crisis. And obviously, anybody who was involved in that situation and who was on Wall Street, there was a lot going on from up and down all over the place. And, our topic is the information environment. And I'm curious, coming out of that experience, writing your book, if there are any key takeaways that you might have in terms of, and anyway, if you read Mike's book, he talks about how basically people around him were doing not kind things, and that ended up getting pinned on him. And I'm sorry if I butcher your tale here, but basically it's, at the end of the day, I have to believe that you learn through that experience how to evaluate people, ideas, and whatnot better. And I'd love to talk about how you're using that first on Wall Street and then your experience in crypto.
Sure. Yeah, no, it's a work in progress, to be frank. It's never something I think that you perfect. Obviously, part of my, I want to say weakness, but also one of the blessings that I have is you want to think the best of people, and you're automatically not hyper skeptical or hyper cynical. And so when that happens, you sometimes run into situations where, you can be misled, and I was misled. But I also wasn't very attentive to the environment either. I had a very misconception, we'll call it, about what the rules of the game were. And part of that, obviously, in the end, it's always my fault. I'm a huge accountability guy and ownership guy. So in the end, it comes back to me. But in this situation as well, you also have a rule field that's not exactly laid out well. And so in insider trading and some of the financial stuff on Wall Street, there is a set of rules that's not really finite, that's not really specific. A lot of it's judge-made law, so it's built up over years. They've never really defined it by an act of Congress. As we've seen recently, there are all types of carve-outs for, and I don't want to go down this path, but obviously Nancy Pelosi and other people in government.
Right. Like what were you doing compared to what Congress people are doing, right? And what was the thing there? Okay, so if I'm understanding correctly, what you're saying is that in your previous life, you were not intentional about your information environment. You were not really being very clear on, okay, what is the game that I'm playing and what are the rules? Did
Correct.
You not internalize the Wall Street axiom, I won't fuck you over as long as you make me money? Or did you stop making people money? And so then they're like, okay, who are we going to, Mike Kimelman, you're done.
Sure. No, and again, I'm not politically protected either. So I didn't realize I needed to have that political protection. I think that a lot of people had. And without mentioning any names, there were obviously much bigger people in the hedge fund world or people who ran the banks. The banks, frankly, were fined or paid something like $400 billion in fines, and almost nobody was investigated or went to prison on account of that. Whereas insider trading, you're talking about in some, maybe $100 million. I ended up, paying a $30,000 fine to basically disgorge my profits in my charge. And that became the focus from Preet Bharara, the U.S. attorney and others. And I think, again, it was a convenient way to scapegoat and shift attention away from some of the more connected players and obviously to ameliorate some of the public's anger. But it's hard to make a case that the hedge fund, the insider trading was responsible for the financial crisis. Not that it shouldn't have been prosecuted. I'm not by any means saying that's the case, but the way it was portrayed as hey, we found a few bad apples and therefore the rest of the system is pristine and fine and trust. That was the story they pitched.
I think that it's crazy. I'm sorry. I think that it's crazy to go after you for $30,000 when the issues were literally 6 orders of magnitude larger.
Well, we agree on that.
I just think it's like, I'm sure what you did was wrong or whatever. I'm sure technically or whatever it was there, but it seems crazy to me. But all right, let's move forward. So you have that experience, and you obviously worked on Wall Street, and you still work in the area of financial investments. Now, I'm assuming most people who watch this haven't gone to jail for making a mistake, but I will assume that everybody who's watching this has been misled financially. I have been misled so many times by people who come in and say, whether, I'm sorry, some internet get rich quick scheme, all these things. Even when I was 11 using the internet, I mean, it has happened so many times that I barely want to call myself an investor. And so I'm kind of interested in what tools or frameworks or models that you use to sort of wade through some of this stuff, and how maybe we can apply it from the financial world to your information diet on Twitter or elsewhere.
Sure. And I think it was Charlie Munger who said, avoiding stupidity is easier than seeking brilliance. That's part of the Munger inversion principle. And that's a good framework for considering things. If you just, in the world of investing, avoid the really bad and obvious mistakes, you'll be around a lot longer. It's a lot easier to make up lost opportunities than it is to make up for lost capital. A lost capital drawdown can set you back years because you're out of the market. You don't have the ability to use compounding for your benefit. And it also, it's obviously a blow to your confidence when you're constantly going in and taking losses. And a lot of that has to do with a lot of other, I don't want to call them amateurish, but non-professional, and professionals make these mistakes too, approaches to the game where they're not sizing their positions properly. They're using too much leverage. And when you're doing either of those, you tend to become emotional. When you see these big swings in P&L, and those emotions cause you to do silly things like panic or trade out of boredom or do all types of other mistakes that will impact, obviously, the long run of your portfolio. But you asked me,
So wait,
go ahead.
Let me do that. Sizing your position, right? Yeah. So there are people who come across a conspiracy theory that turns out to be true, and you can pick any number of them, right? On the left or the right politically. And so then they make that their one issue, right? QAnon. And they go all in with their identity on that particular thing. And is that in your estimation kind of like an analogy to sizing? Like, they didn't size their position. They didn't take like a middle of the road approach, like, hey, I heard about this conspiracy theory. If it's true, it has a potentially big impact on me. Okay, I found out that it's true. This does have a big impact on me, but they don't rotate their entire life around it. To me, like Trump supporters come to mind, especially those in jail for January 6th. They did not size their position correctly.
Right. And that's a great point. And with QAnon or anything else, you have to ask yourself, in assessing these types of information pieces, are the person who's putting it out there, do they have skin in the game in this type of situation? Are their incentives the same as your incentives? Because your incentives may be not aligned in any way. And I'm not just talking about economic, there could be non-economic incentives as well. But if they're not aligned, either way, you have to ask the first question really is, knowing the truth here or knowing the answer, if we suppose there is truth, is it going to meaningfully affect my life? And what is the probability that would happen? And I'm not sure Q or any of those other examples you mentioned, certainly January 6th, yes, that was a failure to consider all of the consequences within the current political climate and whatnot.
Right.
But Q, I'm not sure where the economic benefit is for someone who tends to get consumed in that type of conspiracy theory. And whether it's, Q from the right or the equivalent from the left, it's a great time waster. It's a great story. It's an interesting conspiracy theory. And if it does come to fruition and there's, some grand absolute, change in the political structure or economy or revolution, then yeah, but being aware of it and altering your life and basing most of your actions around that is probably a really low return on your investment time.
It reminds me a lot of sports fandom.
Yeah.
Where people get really caught up in their sports team. And I don't know, I feel like sports fandom is sort of higher than being a QAnon, like really excited for Trump to finally become arrested or whatever. You know what I mean? Like that, because these people are like waiting for this thing to happen. And it doesn't affect them at all. It doesn't help unify them. But the idea of there's a tribe of people, they all do it. They can have social status here because they can be the first to break interesting knowledge. That's all there. But position sizing when it comes to the beliefs that you hold is super important. And of course, considering downstream consequences. Okay, so that, don't make stupid errors. I love that framework. I try to do that, and I still make egregiously stupid errors. And we want to make sure that we're sizing our positions. And do you, at this point in your life, do you even use leverage?
It depends on the asset. So there are certain assets like Bitcoin where I don't, because it's such a volatile asset. It's an exponential technology that hasn't had that full price discovery yet. So 10 years from now, when it finds its level, sure, you'll be able to use some leverage or borrow off it or whatnot. But we saw just recently people who got absolutely murdered. And I've warned against this forever. You can't, an asset that goes up and down 80%, you can never use leverage with. It's just, I don't want to say it's common sense.
Well, and then because the whole transaction log is visible, you can impute how much leverage people are using.
Sure.
And so then you can figure out where their mark to market, and where their, capital calls are going to happen. And then people do that. Well, they'll dump a bunch. It'll cause a cascade because everybody has to dump, and then they'll buy back in at the bottom. It seems like you shouldn't be using leverage at all with crypto assets. And on the other side, you said something very interesting, which is, with such high volatility, you have to ask yourself when you're going to lend against your own portfolio, what is the counterparty risk? Now, it's super obvious now to see after what happened to, 3AU or all these people, that you're not going to get 20% on your money in a safe way, right? You can't put a deposit in and get 20%, no matter how frustrated you are, 8% or whatever it is, with the banks offering less than 1%, right? 0.1%, I think, is the checking account rate at somebody like a Wells Fargo.
Basically.
Right? It's just like, it's like the risk has to come from somewhere. And if it's not endogenous, like to the actual asset, then it's exogenous to the entire asset class. In this case, people who were supposed to be better were, basically running what amounts, in my opinion, to like a Ponzi scheme.
Yeah. And again, like you say, it's really obvious in retrospect, but everybody was playing that game. So
right. Well, nobody wants to lose out. I don't want to be getting 6%, and you're getting 20%.
But it's again, this is the Munger principle I talked about earlier of avoiding stupidity. It's a really bad weighted bet if you think that Bitcoin could be up, depending on your belief and where you see it going. I mean, this is an asset that's been up thousands of % over the last few years. So why are you risking that asset to try to make an extra 6% or 10% or whatever it is? It's just a really bad risk reward bet.
Yeah, that's a very good point, right? It's like we've seen multiple more than 50% drawdowns in this asset. Why would we take any 1 year, even if you take the lifetime of the asset back to 2009, you never want to like put it out for 6%. That sounds fucking great.
You always have those drawdowns. And again, it's trying to make an upside gamble and to accelerate how much money you can make on the upside, but it doesn't make sense with an asset that could go up 1,000% in a very short time frame. It makes sense if you're buying AT&T possibly and trying to get the dividend or doing something in traditional markets where you just don't have, that potential upside. It's the old right.
Nobody expects AT&T to go down 50% unless the broader market is down 50%.
Right. And again, people run into problems in traditional markets all the times doing a smaller, more conservative version of what we just talked about, where, they're either selling puts or calls because they don't think it could go down because historically it's never gone down. I mean, that was the basis of the great financial crisis, where real estate had never been down according to the models year over year. So of course you could lever up and make all types of really aggressive bets. And it's, we used to call it collecting nickels in front of a steamroller or a bulldozer. Like those were the types of bets that people did all the time, selling protection and doing these things where, hey, unless there's a 100-year storm, I should be fine. But the problem is on Wall Street, there's a 100-year storm every 3 or 4 years now.
Yeah, exactly. Right. Well, and of course that's Taleb's entire brain. Okay. So let's bring it back to investing in your work in crypto. So you're receiving prospectus all the time from different crypto projects, from different people that are trying to get you as an accredited investor to invest in them. What if any, how are you sort of cultivating your info environment? So you mentioned source, right? So you think about the source, and then you mentioned not making dumb mistakes. But what sort of other heuristics are you using at play to evaluate these things?
Probably the simplest is you have to tightly examine what the incentives are. And I know we mentioned that earlier, but is the person who's giving me this advice or trying to bring me into this opportunity, where does he stand? Where is his proximity in this whole, pitch? Is he somebody who has the token or equity that he's trying to pitch to me that he knows I will pitch to somebody else? So you have to know where you are in the herd, so to speak. Am I at near the front where I'll be okay no matter what the asset does because I know there's people behind me buying it? Am I in the middle where I have to make a smarter bet because it could go either way? Or am I sort of the dumb money at the end that's going to get completely stamped on? So knowing where you are in the herd, knowing what your proximity is to the real power in these types of situations. And crypto, like Wall Street, there's definitely concentric circles of who has the best information, who has the people that will piggyback behind them based on either their track record or whatnot. So knowing where you stand there and then examining the incentives of the person that's giving you this opportunity is super critical. And it also, you can use your experience with that person to see, hey, has this guy in the past, what recommendations has he given me in the past? How have they performed? Does he stand to financially benefit no matter what? Like if it goes up or down, is he just a paid consultant or does he have actual real skin in the game? And that's why, when you see something on CNBC, you should always be asking yourself, the person who's talking about it, does he own it? What are his incentives? Is he, same thing, skin in the game, or is CNBC talking about something where they're being paid by advertisers and then they have to then, you have to take that into consideration that they're going to give a bullish example here because their advertising model depends on it.
Or they'll platform a bear who has like a perfect bear trap. Okay, so let me ask this question. So you talk a lot about incentives and figuring out where you stand in the crowd. One thing that immediately comes to mind is do you feel like your check size is a good proxy for where you're standing in the crowd? So if you're investing a $10,000 check size with other people who are $10,000, that concentric circle by definition is much smaller than somebody who's investing $100. And so by definition, you're earlier, or is check size sort of not enough? Or
so the basic rule is, and in some ways, once you hit a level, you can negotiate your own deals. So the guy who writes the checks determines the terms. Now, there may be opportunities that are so attractive that even the check writers are like, hey, you get nothing special and you're just with everybody else. We were in an environment for a very long time like that, where companies had the final say and they could dictate all types of terms. Now we're in a tighter monetary environment. So it's the leverage or the spectrum, it's swung much back to the check writer. So you're right, though. Depending on the size of the check will often determine what your access is, how much you're going to be courted, what the favorable terms of the deal will be. And it doesn't mean if you're only writing a $100 check that you're automatically going to be excluded, or if you're a $10,000 guy, you're in because there's people writing 250s and 7-figure checks.
Right.
But what you want to try to do is align yourself with people who either have more experience, more access, have seen more deals and have a better track record than you might be on your own. So it's that army of apes to some degree, or army of ants, where 20 people writing a $10,000 check may have more negotiating power, or may be able to get a better seat at the table than one guy writing that $10,000 check.
Yeah, that's a very good point in terms of figuring out where you're at. The other question that I had was around, so we're talking about incentives, and there is this perception, and this is what I want you to speak to in a second. There's this perception that because crypto is less regulated, so the SEC has less requirements around. So, like for example, for people that don't know, if you're gonna trade or tell people about securities, you have to have various licenses, right? And usually those licenses are sponsored by some bank that has a credential from the U.S. government. It's not really the case for crypto boosters, right? So you see everybody from celebrities to, traditional finance people doing, saying, hey, buy this crypto thing. Do you feel like focusing on the incentives of the person is more important in crypto because the natural structure of the crypto market being less mature makes it so that those incentives are more opaque? And so by determining the incentives, you're actually doing a lot of the diligence work to figure out where the risk is. Whereas, like, if you get advice from somebody who's hawking a mutual fund that's full of ETFs, it feels to me like the incentives are very aligned, right? Like this person wants you to make money because they get paid by assets under management. So they're not going to give you something that's going to go down.
Yeah. And you're 100% right. The flip side of that is, with that information asymmetry, there's a lot more ability to find something that is, a 100x or a 10 bagger, versus in traditional markets, almost all of the extra alpha and edge is sucked out. The edge was sucked out, frankly, in a lot of the cases that took place in the great financial crisis and insider trading and elsewhere, where, a lot of the managers used to be aggressive and look for some type of edge, and then were deterred by some of those cases. So if you look at the performance of equity funds around that time period, they fall off a cliff. There's no longer any great segregation.
I know, right? This is like, and then what you do is you go write a book about your principles.
But then, like you said, that information asymmetry comes with some downsides as well, in that you're not sure about people's incentives and you're not sure about their qualifications. And you get all types of other aspects, which are really ugly, like the rug pulls and coding, whether it's intentional or unintentional coding issues that result in, a contract being buggy and people losing their assets.
Or a hacker, right?
Yeah.
This is, I'm not terribly worried about somebody hacking into the Bank of America and changing my, stock position in AT&T from 1,000 shares down to 10.
And people get hacked all the time in traditional bank accounts and brokerage accounts. They just either replace it quietly because they're making so much money elsewhere, and they don't want that, lack of confidence. But it's different in crypto. You may, people learned with the Voyager bankruptcy, people had money there, and whether they thought it was SIPC, where you were covered to a certain amount, or crypto, in a bankruptcy, you get in line with everybody else, and you may not have those types of protections.
Well, and here's the point, right, is that a lot of these crypto funds are domiciled in weird jurisdictions because they don't want to do KYC, know your customer, or whatever. And, even if it's in Wyoming, so I think they're Switzerland, Wyoming, and Singapore, correct me if I'm wrong, are sort of the three big ones.
Yep.
There is what was that?
Dubai as well.
Dubai as well. I'm sure Dubai has stronger protections than some of the others, but we'll find out. To what extent do you actually have financial standing in some of these jurisdictions with these, sort of fly-by-night operations? Then, to your point, that's all about determining what the incentive structure is from the person who's giving it to you. For me, it feels like an impossibly difficult task I don't feel up to the task on. But then again, to your point, no risk, no return. So I'm not going to get those 100x returns because I basically feel like, because I'm not manipulating the market in a quasi-legal way with a bunch of my friends on a token that nobody understands. Like I've been in technology my whole life. I really don't understand what a lot of these tokens do. Even some of the ones that you talked to me about. I don't understand it. It's like outside my circle of competence, and I have no idea how it is that people can be investing huge amounts of money in these projects. I don't, I understand selling the sizzle, but I just don't understand the stakes. So I constantly look at people like you and I'm like, how are you actually able to figure out what is happening?
Well, you made a great point in that really, if you don't understand it, you shouldn't be touching it. And it sounds like you've been pretty good with that. And I'm a 90% Bitcoin guy. So I put 90% of my assets in the crypto space, whatever I've allocated there, in Bitcoin. 10% I will do more high risk experimental, and I think everything besides Bitcoin is an experiment, and some of them are amazing experiments which may work and produce $1 trillion protocols or economies, but it's an experiment, so you have to understand the risk that comes with it. And just like traditional markets, everything in crypto, it all boils down to risk reward. And if you're trying to get excessive reward, understand it comes with excessive risk, which is why you then have to take other steps like we've talked about today, as well as looking at your portfolio and saying, is this a truly diversified portfolio? Can you say, oh, I'm diversified because I've got stocks and I've got crypto, or not? Because again, in a bad environment, in a risk-off environment, almost everything becomes correlated. So if you don't have at least some cash or some true alternative assets, cash gives you a lot of optionality in case you have these massive drawdowns, which we've had every couple of years, if not more frequently. If you have cash, you have that rainy day fund, you could take advantage of it instead of feeling, like you're losing your hair as you watch your portfolio drop and you've got, 100% of it invested in whether it's stocks, crypto, or anything else, real estate, you name it.
Right. Oh, it's a little overwhelming. Okay. What advice, obviously you want to read Michael's book, Basics of Crypto, but what advice do you have for people that are trying to enter a new information environment, specifically the finance or crypto, right?
Yeah.
I think a lot of what you're rebranding yourself is helping people come through this gateway, because you've sort of been successful multiple times. And so now you're trying to provide some guidance. So what does that do? And if we can relate it to how they would set up their info diet, that would be fantastic.
Sure. And we'll talk broadly again, and then maybe we could dial it down a little bit, but you want to do some of the same things you would do in any information environment, whether it's financial or political or anywhere else. You want to look at, my favorite metric, as I've said before, is skin in the game. Does the person have skin in the game that's advising me to do that, or that's talking about this potential opportunity? Are his incentives properly aligned with mine, whether it's economic or non-economic? Will the correct answer to those questions as well, and whether this is a good buy or not a good buy, or this is a good politician to follow or job to follow, how will that affect my life? Will it meaningfully affect it? And what's the probability that will happen? And then you got to be deliberate about OODA looping that and just going back again and again and looking at it and saying, was this source right? How was it right? How was it wrong? Were the moves I made in conjunction with that advice correct or not? And you have to really look at it. And this is where most novices or amateurs make all their mistakes, besides what I talked about earlier, position sizing, but it's process versus outcome. So a lot of people look at solely outcome. Yeah, I bought it here. I was on 5x leverage. It went up a couple bucks and I crushed it. The process that he's using in that particular one outcome is going to bankrupt that person, 100% of the time. Over a long enough timeline, he's finished. So it's really on dialing in a correct process versus debating the outcome. And that's why there's, and I know this, that's why things like poker or chess with defined, a defined chessboard or possible card combinations, you could learn properly about sizing your bets, learn about pot odds and all those other things that will make you a better trader or investor. And then it's also important to know who you are. Are you a trader or are you an investor? Because there's very different rules for both. And people run into trouble when they say they're traders and they get in a bad, investment, or they buy something they don't like and it goes down and suddenly they're an investor, and vice versa. If you're an investor and you're buying something based on, a deep discount to what you perceive as the fair value, if it goes down 5%, it's not time to bang it out. It could be time to buy more. It could be time to reevaluate. But you have to know who you are, and to thine own self then be true. And then, the final part of that is just block and prune religiously. Anything that doesn't work, or people that misled you, you really gotta, shut those people out. So whether it's on Twitter, whether it's people giving you advice, but it's also knowing where they come from and knowing their incentives. So Bloomberg, used to be a very sort of middle of the road conservative financial publication, and you can get sort of mainstream advice from it. If you've followed Bloomberg over the last couple of years, it's become very woke. It's become a lot more left. It's been peddling ESG and the climate change stuff. There's such a clear narrative that the signal is very poor now for pure investment advice or pure market analysis. So you have to do that filter on everything you read. Just because the Wall Street Journal used to be X doesn't mean now.
The Wall Street Journal is like my classic go-to case, right? Like 2 generations ago, you could be successful as an investor by reading the Wall Street Journal every day.
Yeah.
And today, I'm not so sure that's the case.
Yeah, it's a lot of misdirection. It's business porn, for lack of a better word.
Yeah, my mom called it the National Enquirer of the business world.
Yeah, and it's defending the narrative of the people in charge. It's not great for that subversive investor that's trying to build a large nest egg, as it used to be years ago. And again, that's also because the financial landscape has changed. I mean, people for 40 or 50 years, you could have done the Jeremy Siegel, the Warren Buffett, hey, just buy stocks and you're fine. And that worked for a very long time. I'm not sure that still is there. In fact, I don't think it is. People do, but
Wait. Do you think that we're going to go back into a period where bonds outperform stocks?
I think so, but I think they'll both do poorly, frankly.
Okay.
I think both of them, bonds are going to end up with probably some type of yield curve control. And stocks, for me, demographics is destiny. You had the boomers for 40 years at peak earnings, putting money into the market. That cycle is now reversing, where you have the boomers now withdrawing, from the markets in order to fund their retirement or assisted living homes, or to pay for their grandchildren's college, which is unaffordable, or a house for their children, or whatever it is. So demographically, stocks aren't as attractive anymore. And they're also, wildly overvalued. I mean, if you look at the difference between public companies and private companies and what you can buy private companies at, and I'm not talking the unicorns that will go public. I'm talking about, an HVAC company that's doing a couple $1 million a year in revenue around the block from you. I mean, those things are selling at, 2 to 3 times earnings sometimes, or 3 to 4 times.
2 to 3 times EBITDA, or 2 to 3 times revenue? Yeah,
probably EBITDA, depending on where it is. It could be more, it could be less, depending on the situation. Does the guy want to retire? Does he not have somebody to give the business to? But you're not going to find, you're not going
to be like P, of like 20,
25,
40.
So it's very different.
That's very good advice, Michael. I really appreciate that. Well, that is all the time that we're going to have for today. Thanks again to Mike for coming on. You can find him at MikeKimelman.com, as well as on Twitter. Really good stuff on basically investing, crypto, and then how we apply that to the information environment. I'll see everybody next time. Thanks again.
Thanks, Michael.